Welcome to tonight's live stream where we discuss the Trump 2.0 economy, what's been transpiring since the beginning of the year, and we all know it's been a crazy, wild, up and down time. So we're going to get into some of the things that are taking place, that could possibly take place, and most importantly, what it means for you in your retirement. So a couple of house cleaning items before we get started. We're going to do two raffles tonight. So one raffle in about 20 to 30 minutes and one at the end of tonight's show. So this raffle will be for a $100 gift card to your favorite restaurant. Our marketing team will be in contact. But in order to qualify for the raffle, you have to scan the QR code on your screen and register. You're going to receive a free report. So two raffles tonight. Wanted to get that out of the way. Joining us tonight, though, Chartered Financial Analyst and our Chief Investment Officer, Mr. Chris Paris, and CFA and our Director of Investments, Mr. Charles Scavone. So if this is your first live stream, welcome to the show. If you have attended multiple times before, we thank you for returning, and you guys know Chris and Charles. So we're going to jump right into it because people want to know what's going on with the market. Why is President Trump taking this hammer approach? We're going to call it the stick tonight. In the beginning few months of his term, is the carrot ultimately or potentially going to come in the back half of this year or possibly maybe into next year? We have tax policy, which is hopefully going to pass sometimes this year, but it may not. It seems like there's some congressional infighting. So all of this impacts you and your retirement. But let's first and foremost start with the tariffs and the trade policy, which has led the markets down to begin this year. And Chris, we talked about this at our market outlook for clients. So we do an event every year for clients at the beginning of the year, typically have 70, 80, 90 people in the room. And we felt that Trump 2.0 would be similar to Trump 1.0 because of the expiring deadline for the Trump tax cuts at the end of 2025. But lo and behold, instead of focusing on the carrot, primarily in the first 6 months of the year, first 4 or 5 months, they have decided to bring the stick and start to hammer people. So, it's very understandable why we took that outlook. It's what took place in Trump 1.0. But what's going on with trade policy? Obviously, the markets are going down, but kind of where do we stand now? We had some big news today on that front. So we'll start with that discussion.
Sure. It's only been 3 months since our market outlook, and it's been a very aggressive and eventful 3 months. We had thought, I guess, that we would have Trump 2.0. We would get some carrot, some harmony, some peace up front. We didn't get that. We got the stick. We let the beatings begin early and often. And the S&P 500 dropped 21.5% peak to trough. Most of that actually coming in the last 2.5, 3 weeks when Trump kind of shocked the market with what did he call it? Liberation Day. Liberation Day, where he brought up a screen that instead of 10% across the board tariffs, what the market was anticipating and ready for, he brought a very aggressive plan that no one can make any sense of, I think, to this day. Now, a lot of that's starting to reverse slowly, and let's keep our fingers crossed that we've seen the worst of the tariff confusion. And the reason tariffs are such a negative to your investments is because they're friction, right? They separate you from your money as an investor, regardless of whether they create jobs or not. We're concerned about your money, and the policies, whether they're from a Republican or a Democrat, doesn't matter. It's how do these policies affect you and your money and the return on that money in the next year to 4 years. So,
and really, it's the uncertainty that it brings to the table. We could be talking about any policy proposal outside of tariffs, and if it brought that much uncertainty to the table, the stock market would react quite similarly. So, Charles, what are you hearing on conference calls? So one of the things that as investment managers that Charles and Chris and the rest of the investment team does here, listens to the conference calls, of course, of the companies that we invest in, but you guys also listen to conference calls of companies that we don't necessarily own in the various portfolios because gather a ton of information from industry leaders about what they're seeing on the sales front, on the earnings front, and how policy proposals and actually policy implementation is impacting their sales, margins, and some of the two key drivers of profit. So, Charles, how are tariffs impacting corporations from what you're hearing with your attending the different conference calls from the companies we own and also companies who we do not own?
Sure. Yeah. Well, you bring up actually a number of interesting points in that we do view the world as a food chain. So not only do we listen to we do our, digging in on these companies and grassroots sort of research, but we want to understand what's going on with their customers, their competitors, and their suppliers, because it has obvious implications on what happens for those folks as well. But what you said earlier is, this tariff shock brings about this uncertainty. This uncertainty, when it pervades corporate America, causes C-level executives to take a step back and go on hold. Like, I can't plan my business. So what does that mean? There's going to be a slowdown in capital spending, investments in research and development, hiring plans. So it has very profound
marketing.
It has profound impacts across a whole lot of parts of the economy and their organizations. So you enter into a period like this, and when there is this much uncertainty, executive or CEOs, when they have to provide not only what happened in the current quarter, but more importantly what their outlooks are, they're really not heavily incented to provide a real specific outlook because this uncertainty exists. So what we've been hearing, to answer your question, are companies either withdrawing guidance, saying, we don't know, there's too much uncertainty. Others providing, we saw for the first time, we were laughing, two different outlooks. One, if nothing changes from today going forward, here's what we think we can do. But if we tip into a recession, here's the worst case scenario. Only case I've ever seen where companies provided alternative outlooks. But for the most part, managements are trying to quantify the impact of tariffs at the current level, which we're going to assume is sort of the worst case scenario. We don't think internally, we don't think they get a whole lot worse from here. And so companies are saying that for us, it impacts our cost of goods sold. Some of the materials that we use to build our products are going to cost more because of these tariffs. And so that's going to raise our cost of making the product. Additionally, we may sell it into a market that has reciprocal tariffs, and it's going to make it a little bit more challenging to sell it, so we may have to lower our price. So if you think about what I just said, both of those have an impact on reducing the company's margins, and it's going to reduce their earnings potentially. However, most of the companies are telling us about a 2.5% to 3% hit to their cost they think that they can pass through in higher prices overall. So net, we're not seeing a huge impact on what earnings expectations are going forward. Part of that's due to the fact that analysts, the Wall Street analysts, have already lowered these expectations a fair amount. So the target to hit has been lowered a little bit, and there's a few levers that large cap, well-managed companies can pull some levers to work around that. The final thing I'd say is that when these companies are providing this guidance, they're saying this is as of today, the date, the time, and everything, because this is still so fluid that it could all change, and they don't want to be held accountable if things change.
One of the things we've been seeing, Chris, is which creates more uncertainty for the market, and when you have uncertainty in the market, stocks typically pull back. So I want to come back to what Charles said, but one of the things that has contributed, Chris, to the uncertainty and kind of the precipitous drop in the market since, I guess, a little bit prior to Liberation Day, but really since Liberation Day, was some of the mixed messages coming out of the administration. So you'd have President Trump tweet something, and then maybe you would have another administrative official within the administration say something else or walk it back a little bit. So that kind of leads to a little bit of uncertainty as well.
Yeah, as Troy and Charles are saying, there's loads of uncertainty. Now, I will say there's always uncertainty in the market, right? If you look back over the last 70 years, we had a chart on our website for a long time listing every year the big events that happen. And most of the time it was like a war or something. This time it's tariffs and these policies. But so there's always uncertainty. And by the time there's no uncertainty, the markets will already have been at new all-time highs and they'll have missed the majority of the move. So it's the job that we're entrusted with our clients. But yeah, the mixed messaging, they've gotten a little more on board the last 2 weeks, which has helped the stock market rally. In that, the advisors that are coming out and talking on CNBC, they kind of have a very similar message. Scott Bessent, I think, is it Scott Bessent, has been the biggest, calmest voice most recently. Today there was actually some good news. And I looked at it and I didn't think it was a very big story, but it was President Trump talking about rolling back and giving some exemptions to our automakers for the auto tariffs. And it doesn't seem like a big story, but you start to read the detail. And one, I want to be the software company that's actually following all these tariffs and charging people to try to keep track of it because it's impossible. But it was a scaled back on the tariffs, and it looks like that the 25% plus tariffs that the automakers were going to have are going to be pushed out possibly almost 2 years, and they'll come into play if they haven't met certain production goals. So there can be some offsets, but it was truly, today was the announcement of the first carrot that I saw out there that was like, hey, this might be a roadmap for future deals internally here in the United States for added production on the auto side or semiconductor side. And if that's the case, it's a big deal because we then would have a game plan of, okay, this is what the carrot may look like for increasing jobs here in the United States the next 2 years. First, right now, it's just, we're going to have these huge tariffs. We're going to force you guys to come back here. And no company wants to be forced to invest their money someplace. They want alternatives. Otherwise, they're just going to do nothing or try to wait it out 4 years until someone else is elected.
And you bring up a number of interesting points, I think. So we want viewers to keep some of this in mind. We're always dealing with uncertainty. However, there are points in time in which you can sort of, for us, put pencil to paper and put sort of a probability, right? Look at the risk reward. And that's what we're always trying to do as an active manager, is assess what this risk and reward is. But as you also mentioned earlier, is that some of these tariffs would come out. Number one, when on Liberation Day, it seemed like sort of a random set of figures, and when the market saw that, right, we always talk about how stocks are forward-looking. That created maximum uncertainty, and investors globally just hit the sell button, right? Hit the eject button, because you sort of didn't know where that fundamental level of where your earnings were going to settle out. Since that point in time, things have settled out a bit. Some of these policies are becoming a little bit more known. Companies can begin to quantify it, and you remove some of that uncertainty. And that's what's provided perhaps a floor to where stock prices would go as a result of this magnified tariffs. And so now, to Chris's point, we may be seeing the beginnings of how this will be peeled back, and we can get a better handle on assessing things. The final thing I'd say is that it is at least now not as completely random as it seemed like it was before, right? We all expected, we knew tariffs were coming, but the severity and the scope and then the randomness created sort of this maximum just volatility and unknown for the markets.
So I would wonder, and maybe there will be a book written some point in the future, but I wonder if the severity, the randomness, the unpredictability, if it's all part of a larger strategy. So I've been saying for some time, I've done a radio show here in Houston for the past 15 years, and I've been talking about on the radio how the entire approach that this administration has been taking, I believe, is to create some type of leverage, some type of upper hand, some type of strength for a negotiating position to ultimately walk them back and create more trade deals. Whether or not that's true or not, we'll ultimately, find out. But we are starting to see some of that possibly come to fruition with the auto trade discussion today, where they're going to create some type of runway for some opportunities to adjust, to make it easier for companies to acclimate to this new trade environment. And if that does continue on through other industries, what we could possibly be seeing here is a market that, like most uncertainties that hit the market, whether it's COVID, the most recent one to happen, going back to the great financial crisis from '07 to '09, when you have giant shocks to the system, which create a tremendous amount of uncertainty, markets typically react violently to the downside, but they get to their low point fairly quickly. So it's not one of my clients, but we had a new client join the firm, I'd say probably 2 months ago. And we don't get into politics here at Oak Harvest Financial Group. We strictly care about your money and how, whether it's a political decision or policy, how that impacts the markets, as well as everything else that impacts the markets. We try to boil it down to something that makes sense for you. I was talking with one of our advisors, Ryan, and he said, Troy, we brought this new client over. He was super excited to work with us. And then the trade policies started to react. And despite the plan that we had in place, despite the portfolio being within a range of acceptable downside, so a big part of retirement planning is having a portfolio that we've modeled out all these various scenarios and making sure that if the S&P, for example, is down 10, 20, or 30, or 50%, the impact that has on your portfolio falls within the range that you are comfortable with. So this is a huge part of retirement planning. It helps you avoid multiple dangers, one of them being sequence of returns risk, another one just being the simple emotional toll and anxiety that's created from markets taking significant drops over short periods of time and what that does to your mental sanity. But this guy was really, really anti-Trump, and he became so scared of what was taking place in the economy, let's just say he was very, very adamant that we needed to get him out of the market immediately, and of course we did. We have to listen to what our clients tell them when they're that serious. But point being here is that the emotional response that sometimes we can have, that is a great example of how that impacts the overall retirement decisions. You know, one of the things I'm most proud of that we've done at this firm was we had one client that I'm aware of during COVID when we had the massive drop down 30, 40% from peak to trough within the first couple of months of COVID. One client that I'm aware of that sold everything and went to cash. Of course, that person is tremendously regretful. We talked to them for hours and hours and hours about how this is not a structural issue with the economy and the stock market. We believe it's more temporary. But point being here that I want to make and throw back to you guys is the emotional impact that outside pressure on the markets, whether it's tariff policy, trade policy, whether it's something positive like artificial intelligence, whether it's COVID or whatever's happening outside. When you're in retirement, you are no longer in the accumulation phase. So you have a tremendous amount of greater consequence on the decisions that you're making with your portfolio. So if you get really, really positive news and you want to take more and more and more risk, it's not quite as bad as the negative emotions that cause you to sell near the bottom of different market events, but they're kind of one and the same. So one thing I want you guys to take away is whatever's happening out there in the marketplace, if you're in or approaching retirement, having a level-headed approach, and this is really one of the most valuable things that we do as a retirement planning firm, is pick up the phone. We have a conversation and we say, hey, this is what we see, this is what's going on, but guess what? We have stress tested your plan and we've already anticipated the market dropping 20, 30, 40, 50%, and you can still continue to spend the same amount of money that you're spending now, and you're going to be fine. So when we have these big market shocks, what I'm really getting to here, because I want to always tie this back to retirement planning and how it impacts you in your retirement. Charles, you brought up the point of now that the dust is kind of settling, and Chris, you did too. One, with the auto deal, we're starting to see a possible blueprint for how these, hammer. And let's make no mistake about it. It was hard and it was fast and it was damaging to the marketplace. There's no doubt about that. But we're starting to see a blueprint of the ultimate maybe intention of why they came out like this, is so they can maybe do some negotiations. But Charles, to your point, corporations are now starting to look at, okay, we have some better understanding, brings more clarity to the marketplace. We've seen the market, Chris, you said down 21% peak to trough, and I believe right now it's down about 5 to 7%, somewhere in that range.
On the year.
On the year. Yeah. So we've already started to see some rebound because we're starting to get more clarity. And it's not about whether you love the trade policy, you hate the trade policy. It's not about whether you're for immigration policy or against immigration policy. When we're talking about your money, we're talking about your retirement, the number one thing that matters most is how much certainty does the market have in its ability to predict incoming cash flows, future cash flows of corporations. The more certainty there is to that, and of course the economy is growing and those profits are expected to grow, the more likely it is that the stock market will perform well. But Charles, now that we have a bit more information in corporations, on all the conference calls, of course there's going to be different companies and industries that may be impacted more greatly than others. But kind of right now, 2 to 3%, I wanted to clarify, you said to either margins or to sales growth, the overall impact that you're seeing on average from corporations across multiple industries, that 2 to 3%, what exactly is that?
Yeah, that's to margins. 2 or 3% hit to margins as a result of higher costs, potentially highest possible cost for these companies to produce their products, which they in turn sell either to countries or in areas where they will not have a reciprocal tariff. But if there is a reciprocal tariff, they may need to discount their product a little bit to complete that sale.
Okay, so let's just real quick, so because sometimes we can talk in fancy investment talk. So 2 to 3% on margin. So that means if a company makes $10 and their profit margin was 40%.
Right.
That means they have revenue of 10, 6 goes to expenses, then their profits are $4.
Right.
So 2 to 3%, so that means maybe the profits are going from $4 to maybe, I'm not going to do the math, but about $3.92 or $3.94, somewhere in that range.
Right.
So now we're starting to get some clarity, and all of the investment analysts and investors, they can start to plug these kind of new numbers based on the information that's coming to be more available into their mathematical models, and they can say, okay, if this company is going to earn $3 a share instead of $3.09 a share, I think the stock is worth this.
Sure.
And is it safe to say that's kind of why the stock market has rebounded from that trough of down 21% year to date to where it is now?
You have some degree of, yes, you have some degree of certainty or a higher probability that you're not anticipating a recession, or what's sometimes called an earnings recession, where corporate profits actually turn negative. The economy doesn't have to turn negative, or GDP growth doesn't have to turn negative, but profit growth can slow down. Now the current expectation is for about 7% earnings growth for the current year. I think initially the market was expecting that to be 0 or negative. So now you've probably put a floor in, but you bring up another point I think that needs to be emphasized. What we do, as you mentioned, is we look and put into our models what now is an expected sales, margins, return, all the metrics that drive corporate profitability, because that's what we're looking at, because that's what the stock market is looking at. And so we now at least are getting we can assign a little bit of a higher probability on what we believe that corporate profitability looks like. And so you're getting some stability there. But that's why you need to take a process-driven approach, have a very objective framework that you use to do that, so that you can take that emotional decision making out of the equation, just as you mentioned.
Yeah, and this is, Chris, I'm going to give you a chance to respond, then we're going to do a raffle in a few minutes. And I wanted to acknowledge a few people that are on here that have been followers of this show for a very long time. Anything in addition to add before I do those things?
Only in that, what Troy was alluding to is we were having these discussions on politics 4 years ago with the Democratic president, and from an investment manager standpoint, we may like or dislike the policy. That's not our job. Our job is to figure out, is the policy coming out of DC positive or negative for your money? Is it growth oriented, which was what people were expecting from the Trump just out of the gate? We didn't get it. Or is it frictionary? I call it frictionary. Is it going to create friction with higher taxes, higher regulation, which would separate you from your money, which is negative? And that's really kind of what we're doing when we look at policies in DC. Now, from a taxpayer perspective, I may hate $5 trillion deficits, which or whatever number we were running under the Democrats. But your money as an investor probably loved it because we were spending it in different areas. So if it was invested, your money was getting, employment over here and spending over there. And so right now, with these policies that are coming out of DC, they're all friction. They're cutbacks in government spending, which from a taxpayer I love, but from a spending standpoint, if I'm a consultant working for Accenture or someplace else, I might not have a job. I may not buy my new car. I might not, be able to pay my mortgage. And so we're not really even balancing. We're trying to separate our political views from, is the policy positive or negative for that incremental return, that next dollar of return of your money, and all of this potential pro-growth, pro-construction, pro-production, reshoring of jobs from the Trump administration, great long-term from my viewpoint, but at the same time, think of the last 40 years of investment all of these companies have made, whether it's Apple or anyone else, offshore. And the investor cares about that. We spent $500 billion over the last 40 years.
Well, Charles made the point before the show.
He
said
it took us 35 or 40 years to create globalization. It's going to take more than 100 days to put the genie back in the bottle.
Yeah. Okay, so Drewski, very first person to comment tonight. Of course, you were here a few minutes early. We really, really appreciate your commitment to being here on a consistent basis and always providing a positive contribution to the show. LWS from Ocala. I grew up not far from Ocala, so one, you obviously know LWS, but Ocala is, I believe, maybe I don't know if you call it the horse breeding capital of the world, but they produce Kentucky Derby horses and so many people don't know that. Okay, so we have a few clients here. I'm not going to try to pronounce this. I guess I am. Shosen Za. Is not a client, but from Commie Bay Area, California. Previous comment she made was I liked. It said I'm not looking for Trump derangement or Trump devotional. So kind of right down the middle there, and that's what we tried to provide. So hopefully we are doing a good job for you there. Guys, we're going to do the raffle in a few minutes. If you have not registered, there's a QR code they're going to put up on your screen. If you scan the QR code, you can register. We're going to give away a $100 gift card to your favorite restaurant. Our team will be in contact to identify your favorite restaurant and deliver that to you if you win. We have Mike. Glad you're here, Mike. I know I've recognized your name before. Gail, thank you for being a client. Thank you for tuning in. And then we retired Texas lawman. Help soothe our pains with this uncertainty in the market. I want to retire for good at the end of 2025. I don't know if you're probably not a client, it sounds like, but if you do have questions and you want to sit down, it's not about what the market is doing. It's about how much do you want to spend and how can we create a plan that can operate in any market environment, whether it's doing really, really well or really, really bad. We don't want any of that to impact you and your retirement. So you can probably retire now. I assume you're probably, says lawman there, so probably in the drop program and have some good opportunities to create some good income. And by the way, a recent law was passed called the Social Security Fairness Act, which could benefit you and your family. So if you do have questions, feel free to reach out to us. Got some other people supporting Amerifs here. Larive man. Norm Swan wants to bring up a really good point, guys, and I'm gonna toss this and tease you all in the audience with what we're about to get into. But Norm says, well, that was an immigration comment. You made another one here that I do want to address. Okay. Oh, I lost it. Norm, you made a good comment. The conversation started to devolve in a bit of political argument there, so we're not going to get into the politics of it all. I'll try to find it as when we come back, but you did make a really good point that I think pertains to tonight's discussion. So we'll get to that, but if I don't find that, what we are going to get into is the parts of the economy, the parts of different sectors or which ones could possibly benefit not only right now, but in the second half of the year. So really excited to get into this next part of the discussion. But Heather, I believe we do have our raffle winner for tonight. Tim McLaughlin. Tim, thank you very much for tuning in. I didn't see you commenting here, Tim. I need to see some interaction from you, please. Just teasing, Tim. I've known Tim for a very long time. Tim, congratulations. Very, very happy that you won tonight. Heather from the marketing department will reach out to you and help deliver that gift card to you. Okay, guys, so why I look for Norm's comment, because the one I saw that was kind of non-political, I really wanted to get your opinions on, but I'll toss this to you. One of the things that I've thought has been quite interesting is whether you are a company that was impacted directly by tariffs or not really impacted by tariffs directly. So you're not a manufacturing company that outsources labor or production manufacturing overseas. You're a service-oriented company. We've seen a lot of those companies, no matter which industry that they're in or which part of the economy they're in, the manufacturing or the service side, impacted by the tariffs. So have we started to see a lot of those rebound or not rebound? Which types of companies are we talking about here? And what's been the overall impact to the companies that are not directly impacted by tariffs in the past couple of months?
Yeah. Do you mind if I start? I just want to remind people, so Troy's exactly right, but just to back up, so if you looked at the second half of 2024, the economy was already slowing. Right?
Wait. Say that one more time. Troy is what?
Troy was right. Troy was very right.
Exactly right. Exactly right.
In the second half of 2024, the economy was already slowing into the election, right? If you turned on the TV, you didn't hear it, but we were talking about it here at Oak Harvest on the YouTube channel and stuff, is the data said it was slowing. And it was largely because a lot of the spending programs that were put out there by the Biden administration peaked in July and June of last year in the summer, and they were starting to decelerate into the election. We got a little bump because we all thought we're going to get the Trump growth plan, which is, the carrot was deregulation and lower taxes, and we got the stick. So what happened, it kind of, in addition to the margin issue that Charles has spoke on, you get this double whammy, is that the economy was already slowing into the election, and now we're throwing this big tariff uncertainty on top of it. So you had companies that they don't sell anything that's a product, they sell a service, whether it's advertising or something else, and those companies have been hit as bad, if not worse, than some of these companies that actually are importing goods from overseas. And all you have to do is kind of think of a company like Facebook or Meta. You think, well, what do they have to do with tariffs? Well, a larger part of their revenue last year on the advertising side was coming from a couple of Chinese companies, Temu and Shein, and I can't even pronounce them. But it was billions of dollars that were going into Meta and Google, for that matter, on the advertising side. And the tariffs, which you would think would have nothing to do with advertising, at the end of the day, if China can't sell their goods here into the United States, whether we like that or not as a policy, you strip it away, they're not going to advertise $2 or $3 billion a year. That comes out of Google, that comes out of Meta as an investor, and their stocks reflect it pretty quick. So.
That's one of the reasons why. So as someone who created this firm from a vision of wanting to help people in retirement, the decision that we made to hire people like you and you guys, instead of outsourcing the investment management like so many firms do to third parties and people outside of the confines of the actual building. It's one of the things I'm most grateful for is just one, the dedication, the commitment, obviously the years of experience, but you guys actually put the work in to understand what's going on with different corporations and how that ties into the overall economy, which I can only presume benefits the company, and therefore benefiting
It helps you. You can follow a strictly quantitative investment process. In that's one thing, and some people do that very well. But our belief is that you need to have the other side of the equation. So you want to use your computing power, crunch the numbers as much as you can, but you better be a fundamental analyst as well, so that you can analyze and do just what we're talking about, listening and understanding the impacts across the entire food chain for these companies. It gives you a higher degree of confidence and conviction in the names that you own, such that when you get a wipeout, to call it, like we had, you know that that's a great time to clean your house. You know, we were not positioned completely properly, all right? So what are your weaker positions? Where do you have the lowest conviction? Who are the companies that are going to be in the crosshairs? We're out of them, right? There's no emotional attachment to them. We're out and we'll book those losses and try and at least gain some sort of tax efficiency across all of our products if we can. Then take those proceeds and reinvest them into our highest conviction, secular growth names, the companies that we think are best positioned to handle this sort of environment regardless of what the potential outcomes
so economic dynamics change, whether it's on the policy side or the actual impact on corporate profits. The relative underperformers, we can discharge them essentially from the portfolio, take that capital, redeploy it into either, specifically particular companies that one may have been kind of the baby thrown out with the bathwater.
Exactly.
Or maybe they're, weren't the hottest name last month, last year, but they're in an industry or a sector that could tremendously benefit from a price dislocation that, maybe we want to ride it out for the next 3, 6, 9, 12, 15, 18 months. So being able to, I covered all the bases
You
there.
did. Yeah. You got a lot of years.
Point being is that that is active investing at its core. It's being able to make decisions on the fly from gathering real-time information and then implementing it in a way that's based on years and years of experience, but also what's in the best interest of our clients and the portfolios you run.
Without a doubt. I mean, capital markets are dynamic, so your investment process and program should be dynamic as well. And I get a little bit flustered. Well, I'm a buy and hold investor. Good luck and God bless, but things change, and I want to be able to take advantage of that if I can, and I think that's the way we go about it. The other thing that you said is that it's basically impossible for any one person to manage all aspects of a firm like ours. You need specialized people so that those groups can focus on what their directive is and hopefully can do their jobs very well.
Okay, guys, so we have a raffle coming up in about 15 minutes. We're going to give away a $100 gift card to your favorite restaurant. We're going to put the QR code up. You can scan that, have an opportunity to register and win. Norm, I found your comment, but I also found another comment that I want to point out. And then I wish I had a bigger screen here. So I believe it was C6 Boy says, having a solid pension sure makes, now I had the poll pop up on my side as well. C6 Boy says, having a solid pension makes it easier in retirement. I think that's what you're referencing. So we're going to talk about something in a minute called baseline income planning. And I believe it's one of the best ways to deal with market uncertainty, not just today, but all the future market uncertainties that we will have, because we've only seen a 20% peak to trough drop in the S&P 500 here. Relatively speaking, it's minor. It's happened fast, and it wasn't fun. But it was minor, right? I mean, Norm, to your point, made a comment about the Biden years. He says specifically the boring Biden years never put the markets in a tizzy. Well, I'd encourage you to go check the market returns for 2022. Pretty bad year in the market. Point being here is whether you're Republican or Democrat, none of that matters. Markets are going to go up and down in both types of administrations. Market crashes, bull markets, they're all going to happen in both types of administrations. We're not in politics here, we're in retirement planning. And for you and your retirement, you need a plan, an investment portfolio that if the S&P is down 30%, 50%, we've created a portfolio for you where you're right here, right? You're not going down 50%. You could possibly go a little bit below the buffer in some crazy unforeseen circumstance, but mathematically, we've computed a portfolio to where if you tell us, Troy, I have $1 million, I don't want to lose more than 100,000. In all likelihood, your portfolio will not drop below $100,000 in earnings lost or money lost. Now, when you don't have that visibility and you don't have that understanding, and you're just, let's say, out of the blue, 60-40, 70-30, something like that, yeah, you get a 50% drop in the market and you're only comfortable losing 100,000 on that 1 million, you could quite possibly see yourself drop 250 or 300 or 400,000. That's when you get into the anxiety and the uneasiness and the discomfort, and that's when you run the risk of starting to make some pretty bad decisions that could have long-lasting, damaging, consequential impact on your retirement, and that's what retirement planning is about. Because make no mistake about it, Republicans, Democrats, markets are going to go up during their administrations, and markets are going to crash in both of their administrations. So it's not about the politics necessarily when it comes to your money. You can have your political beliefs, and that's completely fine. Everyone can. But when we're talking about your money, it is absolutely paramount that you remove the political convictions that you have and your beliefs from the equation, because we all suffer from numerous biases that impact our ability to rationally decide the impact that certain actions, policies, presidents are going to have on our portfolio. We're all biased, every single one of us, and we're not being honest with ourselves if we're not admitting that. And not only that, one bias that is extremely important to understand in retirement is confirmation bias. We only seek out information that supports what we already believe, so all of this other information out there, you're completely ignoring. Now, Charles or Chris, let me ask you, as an investment manager, and this can happen to investment managers as well, because we are humans, or you guys are humans. Imagine an investment analyst that looked at investments the way that human beings in this country, because we're so polarized from politics, looked at investments the same way we look at politics, where you only look at the very positive news to affirm your beliefs in a particular company, and all that bad news out there about the way they're doing business and potential lawsuits, and I don't believe that, you just completely ignored because you didn't believe it.
Yeah, it wouldn't work, and we all have biases, right? And I found myself falling into them in the investment world, even though I've been doing this for 35 years, right? So you just have to make yourself self-aware that your money only cares about what the marginal return on the investment is going to be, what the next dollar is going to earn. Is it going to be better or worse than the prior dollar? So a lot of times you'll see companies with huge sales, and the management teams will be cheering each other, and then analysts on the call will be cheering each other, and then I don't know, you spend a little time and you look at the balance sheet and you realize their inventory is going up twice as fast as their sales, and the stock is it's not green anymore, it's red, but everyone's high-fiving each other because they put up a good quarter. But someone out there knows that inventory that's sitting on their balance sheet it's going to be a 2-for-1 sale down the road. So we try to strip away our biases. We all have them, fall into them at times, whether they're politics or just historical experiences. So,
found the question that Norm. Okay, so what Norm said, the point I wanted to bring out was something we had discussed earlier prior to tonight's live stream. He said the U.S. financial position in the world has been severely damaged. Other countries are now looking to have better financial ties directly with each other and bypass the U.S. Norm, this is a very valid point, and it's something that I think is worth discussing. To his point, and Charles, you brought this up earlier, I would bring up the question, let's say France and Russia become better friends. Okay, I mean, maybe I should say Germany, but they're already pretty close with Russia for the gas. Can any country in the world provide that type of demand that the United States provides, or is it maybe the aggregate? If we disenfranchise so many countries that in the aggregate, is it possible that some combination of other countries could displace the U.S. as the consumer, powerhouse? Mike Tyson?
Yeah, not likely, but what you might be willing to pay in terms of the valuation that you'd be willing to pay for that type of demand might be less. You might be less willing to pay up for that demand. And I'll take it in one step back and frame it up as I always do in terms of global macroeconomics macroeconomics, because I know y'all love when I talk about global macroeconomics.
I see the subscribers going through the roof, the viewers increasing.
The world, the global capital markets are a closed loop system. There's a certain amount of capital banging around the global capital markets at all time, and they're looking for just what Chris said. They're looking for the highest marginal return. And sometimes something's undervalued, some things may be overvalued. It's always looking for that optimal return. And I think on a short-term basis, did everything that's happened put a ding in the shiny armor of the U.S. as a premier home for that? Yeah. But will investors forget about that over time? Yeah. And so what goes around, it'll come back around. And to the extent that the U.S. does demonstrate these qualities that are deserving of a higher premium, companies who generate above global average sales margins and return on invested capital.
It all comes back to those very basic things, ultimately.
Right?
Yeah, I mean, we're being sold a story by the media. I mean, I just have to, I'm going to try not to rant too long, but U.S. exceptionalism, right? That term, I don't think I heard it until October or November of last year when the S&P 500 was at 6,100 and had gone up for 15 years in a row. And somehow, in 4 months, we went from U.S. exceptionalism to the crappiest country in the world if you turn on the TV.
Yeah.
And that's total nonsense. It's absolute nonsense. Money has been trying to find another home for decades. If you look at the value of the dollar versus a lot of things, whether it's gold or other things, it's been declining largely because our government, people in Washington, D.C., whether they're Republicans or Democrats, have been printing way too much money, right? And so we're trying to reverse that right now, which is a good thing from a budget standpoint. But USA is still exceptional. We will be exceptional. Right now, money is retreating because it had been treated so well here. Lower taxes, lower regulation, and these policies that President Trump has accelerated, short term, they're friction. And your money doesn't like friction, so it runs away to someplace that it feels safe with possibly a higher return. But the U.S. is still exceptional, and it will be exceptional when my sons are running this country, when your daughters are running this country decades from now, because every other country in this world has the same problems we do with regards to debt and overspending, and we're trying to fix ours.
So we have a couple of questions along the same topic from Joel Deering, and then Larive Man. So I'm going to toss it to you guys in just a second, but we're going to do the raffle in about 5 minutes. So there's an opportunity to register for a raffle. It's a $100 gift card to your favorite restaurant. QR code is on your screen right now, so sign up for that if you want to enter for the raffle. Okay, ports. Discussing, he says, about economic dynamics. Have you seen any reports, Charles or Chris, on the amount of container ships that are coming in and out of ports here in America versus a year ago? He has read that ports are starting to see a dip in activity that could be either inflationary. I assume that would mean because less supply, prices go up. Anything on shipping activity or within the ports? Have you guys seen or heard anything about that?
Yeah, you hear. If you look at port activity, it sort of bounces around all over the place, and I'm sure that there has been a considerable degree of container ships coming into the port, Los Angeles and Long Beach, because that's where a lot of consumer goods come in. Probably a lot of people accelerating orders ahead of tariffs. And so you'll probably then naturally get a lull after that until you see things.
Yeah, I guess
out.
That would be my point. Is I would anticipate. Now it takes time for ships to get overseas, and with the rapid change in policy, the better question might be: have there been ships like halfway here, and then all of a sudden they turned around?
Yes, there have.
But I would expect that we would see an increase in activity as far as shipping into ports. As soon as word got out that tariffs were going to be increased and potentially impact these companies. But then absolutely I would think some type of lull would then occur while the uncertainty is abound. So it's really, I would assume, not too different from any other decision corporations are making during this time of uncertainty.
Agreed, and that's why you saw Apple sent, I don't know how many 747s
like
to pick up,
billion, I believe, or some crazy number.
Where did they put all those iPhones?
Yeah.
That's what I want to know.
Yeah, it's the tariffs
question.
They're creating lumpy supply and demand, right? Yeah. So there's a pull forward in demand. I think auto sales were something like 18.5 million units annualized last month.
Yeah.
That's 1.5 million more than normal annualized. It'll drop off a cliff, next month.
Okay, so
it's very lumpy.
Now let's bring this back to the Fed, because the Fed bases their interest rate decisions on past economic data. Yeah. So now they're really going to be in, this rock and a hard spot. I see you starting to either disagree or just have a strong opinion one way or the other. You think they're going to cut rates?
Yeah.
So, okay, my question is, and I'll let you pontificate on why you think they're going to cut rates. If the Fed has been late for years, right? They've been late on almost everything that they do. But I can't say they've done a bad job, because they've managed a soft landing through a fairly difficult time of high inflation, slowing consumer demand, various other economic data points that haven't been great over the past several years. But now this just brings up a point that two people here bring up with this lumpy economic data, because people are either rushing orders to get ahead of the tariffs or they're significantly cutting back. How does the Fed interpret that data possibly and make decisions about what to do with short-term interest rates?
Yeah, it doesn't help their case, right? I mean, and we've commented numerous times that some of the data that they look at is often revised very meaningfully and tends to be
Sorry,
backward.
is that not a joke?
That's not my word.
Tends to be backward looking.
Doesn't everything they look at get revised after the fact?
After the fact, right? So they say they're looking at more market-based data, and they should be. But I don't know how to. I sit there and listen to these calls.
They're in a very, very tough spot.
Yeah, and I
so
listen,
you think?
Yeah.
Oh, they're going to cut rates.
They're cutting interest rates?
Yeah, they're in a interest rate cutting cycle. They paused. Powell actually, for the first time ever, said he was looking at real-time break-even inflation rates, which Charles and I can pull up. You probably can't on the internet, but you need a Bloomberg. They're declining. They peaked. They've rolled over. He said he's looking at them. No one seemed to caught that except for me. The Fed is a momentum investor.
Wait, so you're the only person in the whole world that caught this?
Apparently so. The Fed is a momentum investor, and the Fed follows 2-year interest rates. They follow 2 years interest rates, and 2-year interest rates are declining.
Real
Are
rates.
they going to cut the ones on your screen?
Yeah.
The ones on your
actually
screen.
nominal rates.
Treasury rates. If you look at the actions of the Fed, they follow by about 6 months the direction of the 2-year Treasury, and it's declining. And it's declining because inflation is actually coming down. It's come down more slowly than they thought. Are they going to cut in May? I don't think so, because their meeting is really early in May. I think it's like May 5th or 6th.
Right.
But they may come out and say, hey, we're seeing the JOLTS jobs number down 600,000. We're seeing temporary workers laid off. We're seeing hours down. All the data on the jobs market behind the scenes, except for mass layoffs, is becoming more negative. I think they'll end up cutting in June. And or if not, they're going to be dovish going forward.
So my view is you always just play game theory, put a game theory analysis on top of this, and you look at it. There's not really anything that's going on currently that's causing the economy to accelerate.
No.
So the bias would have to be to the downside, and the lower rates.
Yeah.
So.
And if they cut, earlier, say it's June or whatever, then the question we get back to, what stocks do you want to be in for the second half?
Higher growth stocks.
Higher growth stocks.
Yep.
That's what you'd want to be in.
Fast Eddie, glad you could join us, buddy. Looks like maybe you showed up a little bit late. Maybe you had a prior engagement, but we're glad you're here. I think Fast Eddie has attended every single one of our live streams since, gosh, what did we start these? 2, 3, 4 years ago? Time goes fast. Eric, when did we start these? Do you know? 3 years ago? Yeah. So Fast Eddie, thank you for being here. Guys, we're going to do our raffle now. I told you it's coming, and we're about to announce it. And we're also kind of running here to, we still got 115. We're kind of at the high end, 21. So We're kind of at the high end, so we're going to keep going for a little bit here, but we're going to do the raffle now. If we can keep over 120, maybe I'll do another raffle in 10, 15 minutes or so. So we just dropped over 118. But if you do have any final questions, we're kind of getting toward the last 15 to 20 minutes here, so please put them in. You guys have been great tonight. I really do appreciate it. You've inspired tremendous conversation up here with us. There are a few things I want to get to in the comment box here that you have put up there already. But Patricia Mooney. So, Patricia, you are tonight's second winner of the raffle, and our marketing team will be in contact with you for delivery of the $100 gift card to your favorite restaurant. So, if we keep up some numbers here, I'll do another one in 10 minutes. Let's put a 10-minute timer on this and wrap it up at that point. I'll throw it to either one of you. We've touched on many different topics. We've actually just kind of got into the Fed and how it could impact the overall market. What do you guys think, each of you, is one of the most important determining factors to how the market performs over the remainder of the year? What do you guys have your eyes on the most? And it doesn't maybe have to be the most, but one of the top 1, 2, 3, 4, one of the contributing factors you think will have a big impact on the market over the next 6 to 8 months?
I framed it up as a trading range based market.
So a technical?
Well, it's you call it what you want. I'd say it's technical, or it's fundamental as well. I think you put the bottom in with maximum uncertainty, maximum tariffs.
Do you think possibly that's already been hit?
That's done.
Unless something out of left field kind of comes in.
Right, of course, right. So, given what we know now, right, which is all that you know now, that seems to be the case. And what will resolve the breaking to the upside or the downside of that,
within this more narrow downward trading range,
it'd be one of two things: either sort of a resolution of tariff and trade policy, which will remove that uncertainty, or does the economy continue to grow, or was it too bad and we tip into a recession?
So
those are the two.
Those are the sort of comes back to the basics, the fundamentals, right? What is the overall impact of trade and tariff policy on sales and margins? As obviously we're in the thick of earnings season, we have we just had Google, we have Amazon, we have Apple, we have Meta, we have
Amazon,
video will be
Apple,
the end of the month.
Meta, and Microsoft are the big
this
four
week.
that are left. Yeah, next couple days.
So we're going to gather a lot of information over the coming days,
Yeah.
but really it's still too soon to even, in large part, identify the impact that corporations are making and even consumers are making on the demand side.
Right.
As to the impact of trade policy. So really, we're probably going to have to wait another 3 months until we get to next quarter's earnings reports, until we really start to see, I would imagine, the true impact, at least in the near term, of policy so far.
Yeah. That seems reasonable, because when the companies are talking in their reporting, other than some of the travel-related companies that noticed or have talked about a very sharp drop-off in travel.
Really?
Particularly Canadian travel to the
United
U.S.
States.
Yeah. And so no big
So they don't want to be the
surprise there.
51st state?
No, I don't think so.
I never understood why President Trump would want them to be the 51st state, because it would almost be like adding another California to the political map.
I'm not sure. Anyways,
you don't know,
it'll take a little while. It will take a little while for it to be, to actually show up in the numbers. But we'll detect the signals as we move along.
I don't know why he would want to do that. Doesn't bode well for their political future, I would assume. But maybe they know something I don't. Chris, what are one of the top 1, 2, 3 things over the next, let's call it 6 to 8 months, that you think would be outside of, he took the easy one. Charles, honestly, I'm a little surprised you took the easy out there of trade and tariff policy impacting the markets. But
what he's saying is, so it's 100% right? Is this
Thank you.
Wait.
It's 2 against 1.
You guys are both
got
right.
You now.
You can't take the same answer. You
I'm not.
got to go outside the box.
The question was,
he named number 1. So
it was April 8th. I think that was the low. We were down 21.8%. Was that max pain in the S&P? Down 21.5%. Was that max pain, unknown earnings, people talking about the dollar demise, people talking about interest rates going too high or too fast? Was that max pain? Because if that was max uncertainty, if you look at history, by the time you get certain that things are okay, the market will be at new all-time highs, right? COVID, think about COVID. We shut the world down. Now, we did stimulate the economy with the Fed and stuff. We shut the world down in the stock market before a recession was declared. The stock market was already back at an all-time high. And before earnings started growing, it was up 25% above an all-time high. Now, we did throw a lot of money at the economy, so I'm not saying that's going to happen. But if we aren't entering a recession, which I don't think we are, if this was just an economic slowdown and we're still in the soft landing, that was the low in April, and we will hit new all-time highs in the coming 9 months because the Fed is going to cut rates, and the PE will be too low for, a 4% yield on the 10-year Treasury.
Now we're not. This is not a forecast or a prediction, and it's definitely not investment advice. But to your point, yeah, that could be a recipe for a rally, right? If the Fed cuts rates and we get more certainty on the trade side.
Right. But I'll interject and throw in the third element. It's the tax issue, right? The Trump taxes. The resolution of a definitive tax plan will be important, and until that's done, that probably keeps a lid on all-time highs.
Well, so we brought up the good point earlier when we were prepping for tonight's show. What if? Because my question was, what's the hammer that could drop that could maybe push us below this 21.6 kind of peak to trough? And right now in Congress, you have a few Republicans that are trying to push congressional legislation to grab congressional oversight on tariff policy. And we are up against a deadline with the Trump tax cuts, the Tax Cuts and Jobs Act of 2017. It expires at the end of this year, and if it expires, taxes are going up for the majority of not only consumers, but the big one, the corporate tax rate back then dropped from 35 to 21. So if all of a sudden they're not able to get this tax bill through, which I believe it's highly unlikely they don't. It may be a last minute like debt ceiling debacle that we have, it seems like every few months. But that could be bad if corporate, because that's not priced in at all. Right now,
it's not.
After tax profits, margins, everything else calculated at 21% corporate tax rates. So point being, if this group of Republicans decide to hold hostage the tax bill in order to gain more congressional oversight on tariffs and trade policy, you could have something basically ending up in some last minute type deal that either may or may not pass in this one big beautiful bill they keep talking about, which would lead to a lot of uncertainty in the market, and maybe we go back to that level.
Right.
But here's the point, and I hope this is becoming clear as the night has progressed. All of this uncertainty, where we see common threads with COVID, with the Great Recession, go back any crisis in this country, it's gotten worse over the past 15 years as high-frequency trading and computers have gained more control over market activity. But any uncertainty creates more violent market swings to the downside, but that's just the initial reaction, driven primarily by the lack of clarity and uncertainty that exists. As more information starts to get pieced together, the market says, okay, I can deal with this. Corporations say, okay, I can deal with this. And once the picture becomes more clear, we get that bounce. But you know what? You don't feel as comfortable, just like we've seen tonight in some of the political discussions in the conversation, and you see on the news everywhere. Stock markets always, I preface that by saying typically always, rebound way before you actually feel better about what's going on. And that's because corporations are far smarter than me, markets are far smarter than me, they're far smarter than Chris, Charles, and everyone else out there, because it's the aggregate intelligence and gathering of all the possible information that's available. And within that loop that you talked about earlier, Charles, that capital is constantly free-flowing around looking for the next highest, most incremental opportunity to increase marginal return on invested capital. That's where it's going to flow, and that's why markets will always react quickly, more quickly than we feel comfortable with what's going on in the economy. So with that said, I'm going to do the raffle in 2 minutes. I feel like I kind of led this conversation a bit astray there, but I think you had something else you were going to add.
Something to add. So it makes me think why it's important that the role of the investment team is to build a handful of different products that do different things that we can put in our advisors' hands so that they can really custom tailor a plan to a client's particular needs. It was an eye-opening experience for me to see a client. Sometimes our advisor will bring it in and say, here's my client's existing portfolio. And I can look at it and I see just a hodgepodge of stuff. And I don't understand how anybody could build a type of financial plan like our folks do using the tools they do. So I would want clients or potential clients to know that that's not the way we operate. What we do is we employ this process we've talked about, looking at these elements of corporate profitability, but we build 3 distinct products for our advisors to use. One is a pure growth product. The other is a growth and income product that provides a stream, a growing stream, increasing stream of dividends. And then we have sort of a hybrid product, which is a mutual fund that has all the growth elements to it, but it has the ability to hedge. It's like a hedge fund, and so it has the ability to cushion downside risk. And so we can deliver different types of product to our advisors to use to try and achieve that.
Ultimately, our advisors identify the goals and objectives of someone, and they have the various tools that they can use on the investment side. And that, of course, doesn't get into the income planning, the tax planning, and everything else that we do from a planning side. So, Nathan, we have our third and final winner of the raffle tonight. We dropped below 100, but I did promise the raffle, so I'm going to keep my word. Who is our third and final winner? John Hunter. Okay, John, congratulations. You are the third winner of our raffle. And I didn't say that you had to be here. I should probably do that moving forward, that you have to actually be here and comment in the section, the comment section there. But John, appreciate you tuning in, appreciate you participating. Our marketing department will be in contact to deliver the gift card to your favorite restaurant. Okay, guys. I'm going to start to let everyone in the office who's here to support us go, but I did also say that if anyone has any questions, please put them in here. So I'm just going to go through a couple of these. If we could do kind of maybe a rapid fire, short response type action, so everyone here can go home, and I also fulfill my promise of answering any questions if they submit them. Okay, so bond yields, bond prices. We get one quick question here from Shosen Sa, same person I referenced earlier. We've seen some violent activity actually in the bond markets, right? Which is a little bit surprising because you would expect stocks going down, flight to safety. Hasn't quite happened like that. Bond market in short.
Yeah, bond market sort of went through what I called a convulsion. There was definitely some liquidity issues in the bond market. What we do here, I focus on that, is focus on super high quality, short duration. We don't 1 to 3 year maturity, 1 to 5 year maturity bonds that, regardless of the impact of interest rates in the market, the movement in these bonds is not very great. They're used to earn a stable yield, coupon yield on them. So, bond and stock correlations don't always hold up like people expect, and so we use them a little bit differently to generate income, stable as much as you can, value to
Shouldn't worry too much about individual bond movements if you're using them for the right purpose.
Correct.
Sorry, the reason I laughed was Norm said if you're trying to predict what the orange turd will do, good luck. So Norm, tell us how you really feel about the president. Again, we don't get into politics here. We don't support or endorse any particular policy. It's not what we care about. This is our professional lives, and we care about your money.
Yeah.
But that was kind of funny. We have Joel says, how do you stress test a retirement plan? So the simple answer is we have sophisticated tools that allow us to look at your portfolio and stress test it, based on the positions that you own, and if you had owned those positions during all of the various market crises that have happened in the past, how your different positions actually reacted, and what expectation, doing a mathematical computation, that you could possibly expect your portfolio to decline if certain circumstances happen in the future. So it requires a computer program. We actually have several that we use. It's a very nice software. I love the software. I think it's the greatest software in the history of the world. It's one of the best software. Continuing with the policy of the Trump discussion tonight. But no, honestly, it's just a look at your portfolio and running it through some mathematical computations to identify what its potential range of outcome would be in various scenarios. So that's what the stress testing is. We have a lot of people rooting for a rate cut. A few people saying great live stream. So looks like, guys, we're wrapping it up. All right. So I want to thank everyone for tuning in. As always, we will be back next month for, we don't have a topic yet. I don't believe we have a topic, but it will probably be a combination of investment and also retirement planning. I would take a guess that it might have something to do with taxes, since that is going to take center stage over the next month or so, because we are up against the deadline for the Trump tax cuts expiration. So we'll probably do something around tax planning. If you are not a client and you have any questions, would like to reach out to us, please feel free. If you are a client, thank you very, very much for tuning in tonight. We value the relationship that we have with you. And of course, if you just have questions in general or anything we can do for you, feel free to reach out to us. So on behalf of the team here, we thank you for tuning in tonight, and we look forward to seeing you next month.